The selection of a universe of comparable companies for the target is the foundation for performing trading comps. In order to identify companies with similar business and financial characteristics, it is first necessary to gain a sound understanding of the target. At its base, the methodology for determining comparable companies is relatively intuitive. Companies in the same sector or, preferably, subsector with similar size tend to serve as good comparables. The process of selecting suitable comparable companies starts with the in-depth study of the target. Toward this end, the banker is encouraged to read and study as much company and sector-specific material as possible. The actual selection of comparable companies should only begin once this research is completed. For targets that are public registrants, annual 10K and quarterly 10Q SEC filings, consensus research estimates, equity and fixed income research reports, press releases, earnings call transcripts, investor presentations, and corporate websites provide key business and financial information. Private companies present a greater challenge as the banker is forced to rely upon sources such as corporate websites, sector research reports, news runs, and trade journals for basic company data. A simple framework for studying the target and selecting comparable companies is shown here. This framework, while by no means exhaustive, is designed to determine commonality with other companies by profiling and comparing key business and financial characteristics. Business profile. Companies that share core business characteristics tend to serve as good comparables. These core traits include sector, products and services, customers and end markets, distribution channels and geography. Sector refers to the industry or markets in which a company operates, which can be consumer products, healthcare, industrials, and technology. A company's sector can be further divided into subsectors, which facilitates the identification of the target's closest comparable. For companies with distinct business divisions, the segmenting of comparable companies by subsector may be critical for valuation. A company's sector conveys a great deal about its key drivers, risks, and opportunities. The proper identification and classification of the target sector and subsector is an essential step toward locating comparable companies. Products and services. A company's products and services are at the core of its business model. Accordingly, companies that produce similar products or provide similar services typically serve as good comparables. Customers. A company's customers refer to the purchases of its products and services. Companies with a similar customer base tend to share similar opportunities and risks. The quantity and diversity of a company's customers are also important. Some companies serve a broad customer base while others may target a specialized or niche market. Distribution channels are the avenues through which a company sells its products and services to the end user. As such, they are a key driver of operating strategy, performance, and ultimately, value. Companies that sell primarily to the wholesale channel, for example, often have significantly different organizational and cost structures than those selling directly to retailers or end users. Geography. Companies that are based in different regions of the world often differ substantially in terms of fundamental business drivers and characteristics. These may include growth rates, macroeconomic environment, competitive dynamics, organizational and cost structure, and potential opportunities and risks. Such differences, which result from local demographics, economic drivers and regulatory regimes, can vary greatly from country to country. Therefore, in determining comparable companies, bankers tend to group US-focused companies in a separate category from European or Asian-based companies, even if the basic business models are the same. Financial profile. Key financial characteristics must also be examined, both as a means of understanding the target and identifying the best comparable companies. Size is typically measured in terms of market valuation of equity value and enterprise value, as well as key financial statistics of sales, gross profit, and net income. Companies of similar size in a given sector are more likely to have similar multiples than companies with significant size discrepancies. This reflects the fact that companies of similar size are also likely to be analogous in other respects, such as economies of scale, purchasing power and pricing leverage, customers, profitability, A company's profitability measures its ability to convert sales into profit. Profitability ratios or margins employ a measure of profit in the numerator, such as gross profit or net income, and sales in the denominator. As a general rule, for companies in the same sector, higher profit margins translate into higher valuations. All else being equal. Growth profile. A company's growth profile, as determined by its historical and estimated future financial performance, is an important driver of valuation. Equity investors reward high-growth companies with higher trading multiples than slower-growing peers. They also discern whether the growth is primarily organic or acquisition-driven, with the former generally viewed as preferable. Using the above framework, the objective is to find comparables with as much commonality with the target, in order to screen out suitable comparable companies for valuation analysis. Please refer to our other video on comparable companies analysis for the step-by-step approach in performing the valuation analysis.